Hey everyone, welcome back to Corporate Decoder. Today AB just filed their latest 10Q report, and I'm seeing a lot of activity that might impact their future earnings. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company's revenues are looking strong, but some of the expenses are really catching my eye, especially when we look at how they're managing their costs. AllianceBernstein, or AB as they are known, is a big player in investment management and related services, serving clients all over the world. They offer a wide range of services like institutional, retail, and private wealth management. Let's dive into the numbers. Looking at their financial condition as of the 30th of June 2026, we see total assets around $9.2 billion. That is pretty stable compared to the end of 2025. Their cash and cash equivalents are up to almost $900 million, which is a good sign for liquidity. On the liability side, total liabilities are about $4.2 billion. It is interesting to note their debt has decreased from $810 million to $580 million, which is usually a positive move. Now let's talk about how they're making money. For the 3 months ending the 30th of June 2026, total revenues were over $1.1 billion, a nice jump from the previous year. A big chunk of that comes from investment advisory and services fees, raking in over $900 million for the quarter. Distribution revenues are also significant, bringing in about $200 million. Looking at the 6-month period, total revenues are close to $2.4 billion. However, expenses are also high. For the 3-month period, total expenses were almost $882 million. That is up slightly from the prior year. Employee compensation and benefits is the largest expense, costing over $471 million for just 3 months. That is a significant amount, showing how much they invest in their people. This led to an operating income of about $289 million for the quarter, a solid increase from last year. Net income attributable to AB unit holders is over $255 million for the quarter. When we look at cash flow, it paints an interesting picture. For the first 6 months of 2026, net cash provided by operating activities was a very healthy $950 million. That is a huge jump from around $490 million in the same period last year. This strong operating cash flow is partly due to a decrease in broker-dealer assets and an increase in net income. Investing activities used about $21 million mainly for equipment and improvements. Financing activities used a significant amount, almost $818 million. This was largely due to debt repayments and distributions to partners. Diving into the notes, we find more detail. The company breaks down its revenues, and it is clear that investment advisory and services fees are the core of their business. For the 3 months, these fees alone were over $1.1 billion. They have long-term incentive plans which involve repurchasing AB holding units. This is a common practice to reward employees and manage equity. Net income per AB unit was $0.86 for the quarter, up from $0.71 last year. This shows improved profitability on a per unit basis. Their investment portfolio is diverse. They hold equity securities, investments in hedge funds, and equity method investments. Total investments were about $433 million. Notably, investments related to long-term incentive compensation were over $42 million. AB uses derivatives like futures, forwards, and swaps, mainly to hedge certain investments. The notional value of these derivatives is quite large, over $880 million. The fair value of derivative assets was about $12.7 million, while liabilities were around $17.7 million. This indicates a managed approach to risk, not speculative trading. The company also reports on how its assets and liabilities can be offset, which is important for understanding their net exposure. This includes derivatives and securities borrowed or loaned. Fair value measurements are crucial. Most of their assets measured at fair value are in level 1 and level 2 categories, meaning they are based on quoted prices in active markets or observable inputs. Level 3 assets, which are based on unobservable inputs and require more judgment, are very small, especially for contingent payment arrangements, which are only about $8.7 million. AB views itself as having one operating segment but serves clients through 3 distribution channels: institutions, retail, and private wealth management. Net revenues from these channels show that retail is their largest, bringing in over $617 million in the quarter, followed by private wealth management at over $326 million. The company is global, with significant revenues from the United States, Luxembourg, and Japan. Looking at the overall results, net revenues for the quarter increased by about $82 million or 7.5% compared to last year, reaching over $1.1 billion. Operating income saw a significant jump of 30.2%, reaching nearly $289 million, and their operating margin improved to 23.2%. Net income attributable to AB unit holders grew by over $44 million, or 21.3%. Expenses are a key area to watch. Employee compensation and benefits increased by about $31.6 million, or 7.2%. For the quarter, this is a large portion of their costs as expected in the financial services industry. Promotion and servicing expenses actually decreased slightly, which is interesting. General and administrative expenses also went down by nearly $13 million, or 8.7%. This is a positive sign that they are managing overhead. AB also provides non-GAAP measures like adjusted net revenues and adjusted operating income. These are meant to give a clearer view of their core business performance by excluding certain items like acquisition, related expenses, and JV equity impacts. Adjusted net revenues were around $887 million for the quarter. Adjusted operating income was about $293 million. This is higher than their GAAP operating income, showing the impact of those adjustments. Their total assets under management, or ARM, are massive, standing at $905.5 billion as of the 30th of June 2026. This is up nearly 10% from the previous year. The institutional channel is the largest contributor to ARM at over $371 billion. Retail is close behind at $367 billion. The company manages a lot of money across different investment services, with equity and fixed income being the largest categories. The filing also gives us a snapshot of the market. It describes a strong performance in US equities, with the S&P 500 up about 15%. International equities also rallied. Bond markets were mixed. This context helps understand the investment gains or losses reported. A significant relationship is with EQH, their parent company. EQH and its subsidiaries are their largest client, and they are increasing their investment in AB's private alternative offerings. There is also a mention of the Equitable and Corebridge merger, which is expected to bring an estimated $100 billion in assets under management to AB over time. This is a huge opportunity for growth. The company's joint venture with Societe Generale has been restructured. AB now has a 49% interest in the North American JV, and they've contributed their interest to form a single JV. They recognized a gain of $48.4 million related to this. The executive overview highlights strong AUM growth, up 9.2% year over year. This growth is driven by both market appreciation and net inflows across their channels. Net revenues increased by 7.5% for the second quarter, mainly due to higher investment advisory fees and improved investment gains. Operating expenses also increased, but at a slower pace, leading to higher operating income and a better operating margin. Looking at risks, there haven't been any material changes mentioned since their last annual report. This suggests stability in their risk profile, at least from their perspective. Interestingly, no directors or officers adopted or terminated any 10b5-1 trading arrangements during this quarter. Finally, the exhibits include certifications from their CEO and CFO confirming the accuracy of the financial reporting. So, what is the story here? AB is showing strong revenue and net income growth, driven by a healthy increase in assets under management and solid investment performance. Their expenses, while high, are growing slower than revenues, which is a good sign. The restructuring of their joint venture and the potential influx of assets from the EQH merger present significant growth opportunities. My biggest concern is the sheer size of their operating expenses, especially compensation, which is always a delicate balance. However, their adjusted metrics suggest they are managing this effectively for their core business. What I am actually looking for is how they handle the integration of those new assets from the EQ8 merger, and if their expense management continues to keep pace with revenue growth. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description.